All right, welcome back to my YouTube channel. I greet you all with good blessings of Christmas and a happy new year. So this is just a continuation on the Eddychuks University free course which I spoke about. We are going to be doing. In the last video I made about the technical analysis, but it wasn't so deep as I wanted it to be. Having been going through the video and then watching what I did, I was just going through the video and then I was looking at what I did, the everything I did on the video, also the recordings and all the things I did were not so deep as I wanted them to be because I intentionally and deliberately want everything I do uh, whilst I am analyzing my own charts, whilst I am doing my own technical analysis, I want to be able to share it out with you guys. Well, that will be for the subsequent videos. I am going to be updating the course every three months so that it will suit our own trading style and then also help us to make informed decisions and then also um, help you guys to know what you are doing in the market. So going further to what we are going to be doing in today's video, we are going to be learning about advanced technical analysis, which are the candlestick patterns. We have the Fibonacci, we have the advanced candlestick patterns, what you should look at for as a swing trader, what you should look at for even as a day trader or a scalper, what you should look at for on the higher time frames perspective. Once you go to the higher time frame, you anticipate thousands of pips into the future, just like as we are going into 2024 go into the higher time frame, look at what the monthly time frame has done for some while now. You look at the candlestick patterns which just presented themselves. You look at all those things and then you also apply the Fibonacci retracements and extensions to help you in your trading decisions. So without saying much, let's hop onto the charts. Welcome guys to the inside of my screen. This is S&P 500 on the monthly time frame. We are going to go quickly over S&P 500 on the monthly time frame and understand what we mean by candlestick patterns on the monthly time frame. This is a very comprehensive way of trading, which I have been doing it for quite some time now, which I have been following my own trading plan and what I look at for from the higher time frame before scaling down to the lower time frame to take my own trading decision. So for the purpose of this video, initially, I didn't include chart patterns for the advanced technical analysis, which I am also including on this video. So we do have three things we are going to be looking at for in this video, which are the candlestick patterns and then also the Fib retracement tool and also the chart patterns we have. So without saying much, let's begin. So what I mean by candlestick patterns most of the traders out there that have been using the candlestick patterns wrongly on the lower time frame. What the big banks do, what I learned from my mentor, was that candlestick patterns are much more reliable from the higher time frames perspective. Once you are able to identify a certain candlestick patterns from the higher time frame, you are able to make your own trading decisions on the lower time frame, because you've known what is going to happen from the higher time frame, because you've known the direction of the market from the higher time frame. You can scale up to the lower time frames to take your own trading decisions. And this is what I am about to show you guys just in a moment. Once you are able to identify these candlestick patterns, being it we do have the, excuse me. Once you are able to identify these candlestick patterns from the higher time frame, you can now scale up to the lower time frames to take your own trading. You can now scale up to the lower time frames to make your own trading decisions. So these candlestick patterns can be, we have different types of them. These candlestick patterns can be bearish engulfing, they can be bullish engulfing, they can be morning star, they can be dodgy candlestick, they can be evening star, and so on and so forth. But for the purpose of this video and for the sake of what I've been seeing on the chart mostly, we are going to be looking at the um, bearish and bullish bars. Then we are going to be looking at the morning star and evening star formations. Then we are going to be looking at the pin bars. We have a lot of candlestick patterns, which most of them I haven't seen them on the higher time frame, which also helps us to make these trading decisions. This is an advanced technical analysis. This will help you to make good trading decisions. Once you've come on the monthly time frame and you are able to identify these candlesticks, this is what we call technical analysis. This is what we call advanced technical analysis. Once you are able to come on the monthly time frame and then identify these candlestick patterns, being it bearish and bullish bars, bearish and bullish bars, also bearish and bullish engulfing, or bearish and bullish, also bullish or bearish engulfing, or we have the morning star and the evening star formations, and we also have the pin bars. Once you are able to come on the monthly time frame to identify this and then scale down to the lower time frames to look at the chart patterns we have. First, I told you guys we are going to look at the candlestick patterns, then we move on to the chart patterns we have. Then we move on. The last one we do Fibonacci retracement tool. We learn how to use that tool in a more variant way that will help our own trading decisions. So once you've come on the monthly time frame and you're able to spot these setups, being it in a bearish or in a bullish trend, you can be able to take your own decisions. Being it in a bearish or in a bullish trend, you can be able to take your own decisions, trading decisions, which will help you to capitalize from the market and also help you to grow your capital in a more sensible manner rather than trying to flip your account, trying to move $100 to whatever amount you want to have in just some time. This will also help you Why I love swing trading is because it allows you to do other things. Once you've spotted these trading opportunities from the higher time frame, you scale down, wait for your trade setup to happen, then you take these trades. And once it has presented another opportunity for you, your own responsibility is to be adding more to your positions. Your own responsibility is to be adding more to your own positions, so long as the trend continues to trend. So long as the trend continues to trend. So this is it for S&P 500. We are going to start right. Sorry, my network was bad. So for S&P 500, we are going to start right from where. Sorry, my network was bad. So for S&P 500, we are going to start right from the bottom, where it all started to trend to the upside. We're going to be able to identify these candlestick patterns, just like I said. I'm going to be able to identify these candlestick patterns, just as I said in when I was explaining these candlestick patterns and how you can trade from them from the higher time frames. We don't trade on the monthly time frame. We don't trade from the weekly time frame. We only go up there to feel the market. We only go up there to look at what the market has for us. We only go up there to look at the overall direction of the market, and then we scale down to the lower time frames to make our own trading decisions. We scale down to the lower time frames to then make our own trading decisions. This is what we normally do from the monthly time frames perspective. So coming to this point, after you've marked your support and resistance from the higher time frame, then the next thing you will do is to identify these candlestick patterns. These candlestick patterns. The candlestick patterns are more than these three. Why I say that is because we do have a lot of candlestick patterns. We do have the tweezer top and tweezer bottom. We do have the hanging man. We do have many of them, but these are the most ones that occur from the higher time frames perspective. And once you've seen these candlestick patterns happen on the monthly and on the weekly time frame, be rest assured is going to go in the direction which represents any of these candlestick patterns which I have just mentioned. So for here, we had an inside bar formation, and this inside bar formation gave rise to this move to the upside. This is an inside bar formation because it is inside this bearish long bar. It is an inside bar candlestick. So this is another tweezer button candlestick on the same level, as we saw this last one, on the same level as we saw this inside bar happen. So after that, what happened? This is a tweezer button candlestick formation. These candlesticks are much more reliable from the higher time frame perspective. Imagine seeing 10 of um, tweezer buttons on the 1 hour time frame in the same places. What are you going to do? Definitely, you are not going to know which direction the market is headed to, because you have not seen what is on the higher time frame. You have not gone to the higher time frame to identify these candlestick patterns that will help you in your own trading decisions when you scale down to the lower time frame. So once you've come on the higher time frame, you can be able to spot. I believe this has even opened your eyes to your own trading, the style of your own trading. You come on the higher time frame, then you look for this candlestick formation. Even if the trade has left you, you know that yes, this is a candlestick formation. This is a tweezer button. And what happens immediately after tweezer button forms? We normally see a massive move to the upside. And this is just what we've seen. We saw the massive move to the upside, which made about 7,000 pips to the upside. what happened here when we had the inside bar formation? We saw a massive move to the upside, which made about 3,000 pips to the upside. These are the original ways of using candlestick patterns. These are the most legit ways of using candlestick patterns. Once you have identified a candlestick pattern from the higher time frame, you can be able to scale down to the lower time frame to take your own trading decisions. This is a tweezer button which gave rise to this massive move to the upside, and then we saw a bearish engulfing from the higher time frame, from this monthly time frame, which went to the downside. Note, the most reliable of these candlestick patterns form at the areas of resistance and support. They form at the areas of resistance and support. They form at the areas of resistance and support. I'm repeating this because somebody might come and see in the middle of a trend, somebody might come and see in the middle of an uptrend, somebody might come and see a bearish engulfing. And then after that, if nothing happens and the trade continues to go high, they will say, yes, I said once this has happened on the higher time frame, you can be able to take that trade in that direction. No, you must be able to spot. That was why I did the technical analysis techniques first. So you must be able to spot these supports and resistance. Then um, you draw your trend lines, then the next thing for you to do is to look for your candlestick patterns on these supports and resistance. On these supports and resistance, this will help you to make your own trading decisions. This will help you to make good trading decisions. I know why I am saying this. You must be able to draw your support and resistance before looking out for these candlestick patterns forming on this support or this resistance which you've drawn. This is a clear support area of price because the first time price came here, it rejected and then came here again to test this thing with a tweezer button, which gave rise to this massive move to the upside. This again is another area of support. How do you know areas of support? Go and check my last video. Go and check my last video. You'll be able to understand, yes, these are areas of support because I don't have that time to start explaining. Areas of support are the, the greatest turning point in the market, same as the areas of resistance. They are the greatest turning points in the market. This is a great turning point in the market. Then what do you now do? You call it an area of support because after this, we saw the massive move to the upside. After this, we saw the massive move to the upside. This is another great area of support. After this, what did we see? We saw a massive move to the upside. Then coming here, this is another great area of resistance. After this, what did we see? When price reached at this point, what did we see? We saw a massive drop of S&P 500 to this support level, which gave rise to the move upside. This is a massive support level of price on S&P 500. What are we going to expect next on this resistance bar? Is for price to also respect this resistance bar because this was a previous resistance level of price rejecting from this point. So what are we going to be expecting is for price to also respect this point again, either come down to this support level or come down to this minor support level we do have here. Though this is a chart pattern which created the neck and the inverse head and shoulder pattern, which broke out of the neckline and then pulled back into the neckline to retest it before the continuation to the upside. Before the continuation to the upside. So this is an area of resistance. We are going to be expecting for price rejection from this point. We are going to be expecting for price rejection from this point to this point, or maybe a rejection to this point, then break it and then pull back to use it as a support to then continue the trend to the upside because this is a reversal candlestick pattern. When this was going down, we had the reversal candlestick pattern, then it continued going up, broke the neckline, we pulled back, and then very much to the upside to the next fib extension point, which I am going to be explaining to you guys after I am done explaining these candlestick patterns. That was just an explanation on support and resistance. Make sure you are able to watch the video I made previously to be able to understand where these support and resistance they work the most. Support and resistance are the greatest turning point in the market. Once you are able to identify these turning points in the market, you can make for yourself good trading decisions. Even when your strategy doesn't work for you, you know that you are right on what you are doing. Even when the market doesn't comply, know that you are right. So long as you stick to your own plans, so long as you stick to your own trading rules, know that you are even going to make it in trading. So once you've joined the support and resistance, you go ahead to identify your chart patterns, which can be bearish engulfing or bullish engulfing, or the morning star and evening star formations, depending on the trend of the market. Depending on the trend of the market. Remember, I told you these candlestick patterns are much more reliable on areas of resistance and support. Then we have the pin bar. We also have other candlestick patterns, which are the hammer which we had here, which are the hammer, which is the hammer which we had here. After that, this reversed price, the neckline of this inverse head and shoulder. We also have the tweezer button and the tweezer top, which we also had here. This is a tweezer button candlestick formation, which gave rise to this massive move to the upside. This is also an inside bar formation, which gave rise to this resistance level here. And then after that, price came here and then made this beautiful tweezer button, which gave rise to about 7,000 pips to the upside. So enough for the candlestick patterns. We are slightly going to move ahead to the next one, which we have, which are the chart patterns we do have in trading. Chart patterns are reversal candles. They are reversal patterns in the market. Chart patterns are when the market is about to reverse. It shows a particular chart pattern that makes the market reverse. So what am I trying to say? What am I trying to say? After you've done this on the monthly time frame, you go ahead to scroll down to the weekly time frame. These chart patterns can vary depending on the time frame. Sometimes they come out on the monthly time frame. Sometimes they come out on the weekly time frame. Sometimes even on the daily time frame, you can find these chart patterns. But the most reliable of these chart patterns and where they form are on the monthly and on the weekly. The daily is just for direction of the market. But once these chart patterns form on these three time frames, they are very, very good. But even much more reliable when they form on the monthly and on the weekly time frames. They are even much more reliable once they formed on the monthly and on the weekly. This is just a tip of the iceberg of what you should know about technical analysis. It's very, very deep, but once you've understood the whole thing about the market, once you've gotten like a taste of it, once you've known, yes, this is what you are supposed to be doing, definitely you're not going to understand everything about the market because it is a continuous process. It is a continuous process. Let me just put it like that. You keep on learning, you keep on going, you keep on doing what you have to do because you have to do it. You don't have a choice. If you want to really get good at this skill, you don't have a choice. You keep on learning. So for these reversal patterns, we do have the inverse head and shoulder, and we do have the normal head and shoulder, which I am going to draw here. So this is the inverse head and shoulder. We have these things form at areas of resistance and support. This is the inverse, this is the left head, this is the head, and this is the left shoulder, this is the head, and then this is the right shoulder. This is an inverse head and shoulder patterns. If you read the PDF, which I told you guys to read about, and which I posted in the Telegram group where I normally post all these things, you understand the meanings of chart patterns and their reversal meanings and all those things. This is an inverse head and shoulder. This is a head and shoulder pattern candlestick formation. Once this one forms in an uptrend, note that the uptrend has been validated to continue to the downside. Once we have this in an uptrend, take for instance, we've had this print here like this. We've had this print here like this. This is telling us that yes, we are no longer bullish on this trade. If at all the neckline of this inverse head and shoulder is broken, then we are no longer bullish on this trade, but then we have turned to bearish. Note that these chart patterns are much more reliable from the higher time frames perspective, but most of the times they work a little of the time they don't work because of market conditions and geopolitical events which take place in the world. Once you are able to understand all these things and then combine them all into your own trading decisions, you are going to be very, very good at what you do. Though you're going to experience series of losses because um, no strategy is no strategy is 100% guarantee that there will be no loss. Every strategy has a fault in one way or the other. So these candlestick patterns are these chart patterns are reversal signals in the market, which tells us that if in an uptrend the market is going high, and then we have a normal head and shoulder. This is a normal. I call it the normal head and shoulder. This is the head, this is the left shoulder, this is the head, and then this is equally the right shoulder. If in an uptrend we had this print out, then we know this whole entire uptrend is done. We are no longer bullish on S&P 500, but then we are bearish, and then we will see to the downside. If not for this, come for this. But once these chart patterns have presented themselves on these higher time frames, they are very, very much reliable for us to make our own trading decisions. So the next we have is the normal head and shoulder pattern. The next we have is a normal head and shoulder pattern, which was what we saw here. Also, this was the left shoulder, this was the head, and then this is equally the right shoulder, which gave rise to this massive move to the upside, about 521 pips to the upside, which gave a massive move to the upside. This is a reversal chart pattern. When this market was above here and it was making series of lower highs and lower lows, making series of lower highs and lower lows, making series of lower highs and lower lows, until we saw the left shoulder, and then we saw the head, and then we saw the right shoulder. Basically, we're waiting for a break of this inverse head and shoulder, and then we had the pullback into the inverse head and shoulder, and also we had the pullback into the Fib golden zone. So how do we now trade? How do we now trade these chart patterns? How do we now trade these chart patterns? The best ways to trade these chart patterns is to always wait for the breakout. Let's take for instance, if you sold S&P 500 from this point, note, we don't trade on the monthly time frame. This is just an instance. This is just an example I am giving you to understand what I am saying. If we're trading at this point and our stop loss was above here, and then our take profit was above here, once our take profit is reached, and then we saw a massive move to the upside, and then we came here, and then we couldn't break this last low because this was in a downtrend because of what we're making lower lows and lower highs, lower lows, lower highs, lower lows, lower highs. Once we've come here and then we put on a lower low and the market has failed to break this low. This entire downtrend is validated because we are now in a correctional phase to the upside. Why? Because this was the previous last low we made before this one. This was the previous last low we made before this one. And then to your own understanding about chart pattern, we have put on a lower low and then we made a lower high, and the market came and then put on a lower low below this low. Below this low. And then we have soared up, and then we came here, we couldn't break this low. What will it tell you as um as a smart person? What will it tell you as a smart person? Since this is a chart pattern reversal, you then allow the market. Imagine if you bought here and then market went here, your stop loss was in break even, came back and took you out and then continue. It is always advisable to wait for the break of these chart patterns, for the break of the neckline of these chart patterns, for the break of the neckline of these chart patterns. Here we have it that our neckline was somewhere around here. Here we have it that our neckline was somewhere around here, and then we have broken the neckline of this inverse head and shoulder, which is also a reversal chart pattern. We have broken the head, and then it is always advisable. I know why I am repeating it, because for some people, once they have seen this chart pattern print out, the next thing, they won't even wait for the breakout. They'll just jump in without even waiting for the breakout or waiting for a proper breakout and then a space from this resistance level to then price for price to pull back into this neckline and then retest it. Most people won't wait and then they will buy here. Just take a look at what the market did. Once they have seen this chart pattern printing out, they will buy here, and then once the market have reached here, it will reverse back. If your stop loss was in break even, it will take you out. So what is the most advisable way? What is the most advisable way to trade these chart patterns? Is to always wait for the breakout of this chart pattern. This was the breakout. We saw the pullback, and once price reached here, you saw the massive move to the upside. Once price reached there, we saw the massive move to the upside. This is a clear indication that chart patterns are very, very much reliable and very, very much important from the monthly time frame and then from the weekly time frame. Once we are able to identify these chart patterns from the higher time frame, can be able to scale down to the lower time frame to make our own trading decisions. So, and same thing for the normal head and shoulder we do have. Same thing for the normal head and shoulder we do have. We had the left shoulder, we had the head, then we've had the right shoulder uh, chart pattern reversal. So imagine we're going on a higher high and higher low. We're making higher high and higher low. We're making higher high and higher low. Making higher high. And then market came here, made a higher low, and then it failed to break this previous high, and then came here and broke this previous low, this previous higher low, making it a downtrend, It went back, retested this support level, and then we broke out of this normal head and shoulder pattern. We broke out of this head and shoulder pattern, and the market had pulled back into this neckline to retest it. This is the same thing we had for the inverse head and shoulder pattern, which market made the left head, the left shoulder made the head, and then we had the right shoulder. Always wait for the breakout of these chart patterns to happen. Always wait for the breakout of these chart patterns to happen before you make your own trading decisions. It is always advisable to wait for these breakouts to happen before you make your own trading decisions. Once you are able to wait, the market will present itself for you. Imagine those that were waiting for this pullback to happen. And once it reached normal point. They executed and then went about their own businesses for the rest of the year. And imagine them returning to this massive amount of pips to the downside, massive amount of pips to the downside. That would be a very, very good trading for the entire year for those who have bigger accounts, for those who have a lot of money to invest in the financial markets. This will be a very, very profiting year for you if you have that kind of money that will make you millions and millions of dollars from the financial market. So this is all about chart patterns. We do have other chart patterns, but these are the most reliable ones. Uh, we do have the double top, which is also a, a, a primary chart pattern in the Forex market. We do have the double top, and then we have the double bottom candlestick, similar to the inverse head and shoulder pattern I showed you guys about, similar to the inverse head and shoulder pattern I showed you guys about just some seconds ago. Always wait for the breakout of these candlestick patterns to happen. Once you are able to wait for the breakout of these candlestick patterns, that these chart patterns that I've shown you guys, always wait for the breakout. So imagine this was a support, this was a support on this one, and then imagine this was a resistance on this one. Imagine this was a support, price came here, rejected, and then came to the resistance and rejected, came here on the support and rejected, came here and then rejected on the resistance, came here. This will show you that, yes, this is a chart pattern reversal. If it was in a bullish market before, if it was in a bullish market before, and then price came here and then made this chart pattern, this is a chart pattern reversal. This is a trend reversal from the higher time frame. And then what are you going to do when you scale down to the lower time frame? Is to wait for the break, the proper break of this neckline, because this is a double top formation. Wait for the proper break of this neckline. Once it has broken the neckline and then given enough space, enough room for buyers to set their orders, it will come down, it will come back to the neckline. It always does it. It always does it. To come back to the neckline and then retest the neckline. Retest the neckline of this double top. Retest the neckline of the support region on the neckline. Then the trade will continue making lower highs and lower lows, depending on where the next valid support, where the next most important support is from the higher time frame. So this is same thing we have for the double bottom. Always wait for the breakouts to happen. These chart patterns happen very, very often. Just that I don't have the strength to start looking for all these things on different charts. This is the very best of way I can explain this for you. Once you are able to spot these chart pattern reversals from the higher time frame, just like we did on this S&P 500, which gave us a massive move to the upside. I had predicted this a long time ago when I recorded the video telling you guys we are having the pullback into the neckline of this inverse head and shoulder, which after that market saw at the upside for about 420 something pips to the upside. That was a very, very, very simple setup we saw in the market, because market had made the inverse head and shoulder and then broke the neckline. We saw the pullback coming. Little did I know it was going to reject immediately from the neckline and also from the support of this S&P 500. Same thing we have on the double bottom is the same thing I'll tell you guys on the double top. Same thing we have on the double bottom is the same thing I will tell you guys on the double top also. Always wait for the break to happen. Always wait for the break to happen before you make your own trading decisions. Always wait for the break of the neckline to happen for these chart patterns. Wait for the break. Next thing, you wait for the pullback, and then you continue your trade to the downside as much as you want. The purpose for pullbacks is to allow you to add more positions. This is where it even starts making you money, because this is where you add most of your provision after executing from here. After executing from here, after the pullback has happened, you place your stop loss, and then your profit target will be obviously the next significant support level, or the next most important resistance level in the market. So once you've placed your trade and it reaches here, you see a breakout, you see a pullback, you move this one to break even, you move this one to break even. What you are trying to do is to secure some of these profits which you've made from your first entry, so that these ones can also, even if it goes against you, you know it will cover for the subsequent ones you've opened when the trend was still on a go. So once you've done this, wait for pullback to add more positions to your own trade. That is very, very much for chart patterns. Very, very simple. Once you are able to go on the higher time frame to identify these candlestick patterns, to identify these chart patterns, you are going to make a good trading decision. So next we do have is the Fibonacci retracement tool. Next we do have is the Fibonacci retracement tool. What is the Fibonacci retracement tool? Fibonacci retracement tool was made by a man called Fibonacci, which is the collective human behavior. This is what everybody thinks in the society. This is how everybody behaves. And then the Fibonacci tool is very, very powerful in a way that with it, you can be able to also draw your support and resistance if you really know how to use the Fibonacci tool to do all these things. Excuse me, guys. So you can use these things to your advantage, like the Fibonacci tool, is for us to be able to know the next turning points in the market. Take, for instance, you draw your trade from, this was an uptrend. It was making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, and then higher low. So take, for instance, this was a trend you were in. Uh, you were you were you were at this point in the trade. You are waiting for the setup to pull back into this resistance level is broke, which is going to use it as support to then continue the go to the upside. This is what you do. You pull out your uh, Fibonacci retracement tool. Depending on the trend, you pull out your Fibonacci retracement tool from swing low to swing high of that trend. Then you mark out the golden zone, which I already told you guys about. You mark it out. You also mark this fib extension points where you are going to take your profits subsequently if the market should reach there. You take away your fib. This is what I call the Fibonacci tool, because it has helped you. This is a collective human behavior. Definitely everybody uses this in the forex market. This helps you to know the next turning point in the market. So this market gets here, and then we see a massive rejection from this golden zone. Sometimes it likes to misbehave by going as low as this point. This is called the deep retracement. This is called the turning point in the market. And then there's a one which is not really necessary. This will serve as your TP1, where this white line is. This will serve as your TP1, and then this will also serve as your TP2 in the forex market using the Fibonacci tool. Very, very important way of using Fibonacci tool. I'm going to still explain this in the chat so you understand what more I am saying, and you can visually use it on any chart at all. Just that I don't have the strength to be scrolling through chat looking for the best things to show you guys. So we are going to be doing that. Um this is just an introduction to what I am just trying to let you guys know, and then try to teach you guys how I trade. Also see how I see the market that has been making me profitable, has been making me consistent in my approach for a very long time now. So this is S&P 500. So this is S&P 500. We had the chart pattern reversal, which is the inverse head and shoulder. So when the market was pulling down low, you look out for your last low. You look out for your last low. At this point, this was our last low because price came in and then made this double bottom to the upside. This was our last low. This was our last low in the market. You take out your Fibonacci tool, you draw it. This is when you know we are having a retracement back. You take out your Fibonacci tool, you draw it from your swing low to your swing high, and then you mark out uh, your own uh, your own golden zone. You mark out your own golden zone. You mark out your own golden zone. These things can be done on the lower time frame. I'm just using the monthly time frame because it has a less amount of candlesticks, which will also make us to focus on less amounts of candlesticks rather than seeing thousands or hundreds of other candlesticks, which will in turn confuse everything for us. I'm a swing trader, so I don't go below anything below 4 hour time frame. I always stop at the 4 hour time frame because I want to really master this. I want to really know the art of trading and also understand how the big boys are able to move the markets. And then even when it is the most news people fear, I'm relaxed because I've seen what is on a higher time frames perspective, and also I also know what is going to happen when I scale down to the lower time frame. This is how I make my own trading decisions. Remember, I am using the monthly time frame because the number of candlesticks are so large. There are so many that to confuse me on how I intend to explain these things for you guys. So imagine we are on the daily time frame, and then we have this break of the inverse head and shoulder. We have the pullback into the neckline, and then what you definitely do is, let me go to the daily time frame. What you do is, this was a swing low of the market. What you do is, you don't take your trade at this point where price is still in the golden zone. What you want to do is to get a candlestick closure above this golden zone. Once you've gotten a candlestick, if you want to be aggressive, you can enter right from here. You can enter right from inside this bar, inside this box. But it is mostly advisable and always advisable you don't take your trades from the support levels. You always want to see that first bounce off from the support. Sometimes you miss these setups when you are waiting for um, the the first bounce, and then you wait for the retracement. Like this one, if you're waiting for a pullback to give you chart pattern on the daily time frame, you will never you'd have missed a lot of pips the upside. So what I normally do is to wait for a bounce off um, like one or two candlesticks from this golden zone, also the support zone. Once we've gotten one or two candlesticks, which are very, very much reliable, and then we get a close of a candlestick above this 50% region, we get a candlestick above, we get a candlestick close above this region, then it is a good buy for us. It is a good buy for us. We place our buy here as stop losses comes below the low of the market. This is where you use your risk management calculator to calculate the number of lot size you are going to use, depending on the pips, the stop loss variation, and then the take profit variation. Your first level target will be definitely the O point on the fib extension, the first point after the golden zone, the first point after the golden zone. This is my Fibonacci setting. You can go ahead and copy it. This is my Fibonacci setting. I have the 0, I have the 0.618, 0.618 region, I have the 1% region, I have the -1, and I have the 0.5, I have the 0.786, I have the 1.618 region. All these things, this one is values, this one is right, this one is middle, and then this one is 14. No background at all, because I don't want the background. No background at all. We have the prices, we have the level. So that is all for my fib settings. So our first level target will be here, and then obviously and very much well, and then very much well. Sorry, that was a mistake. Let's be 500. So I'm very much well. Our next level target will be the next fib extension point. The next fib extension point, which I haven't set yet. Sorry, it's not coming out. But our next fib extension point is somewhere above here. I will do it and send to you guys. But our next fib point is usually the TP2 in conjunction with the resistance level. This will be our next level target for S&P 500. This will be our next level target for S&P. Always take out your 50% positions on the first fib level profit target. Always take out 50% of your positions, because sometimes the market likes being crazy. Once it reaches here, it reverses back to test this support level before the continuation of. Imagine if you are not psychologically fit, and then you allow it to reverse back, comes here and takes you out in loss, not even in profit, then you must be a fool for allowing that to happen. Take out 50% of your profit here, move the rest to break even. So even if it comes back and takes you out, it will be a very, very risk-free risk trade. You didn't lose, then the market did not take anything from you. Sorry. So that is it for. So that is it for this video. I believe I've made so much impact on you for from understanding candlestick patterns and how they are being used from the higher time frame perspective, to then scaling down to the lower time frame to look out for your trading opportunities in the directions of these candlestick patterns which they form, whether being it bullish or whether being it bearish. And then we went forward to look at the chart patterns, which are mostly very much reversal chart patterns in the market, which they are the inverse head and shoulders. We have the normal head and shoulders, which is what we intend to call as the head and shoulder. Then we do have the inverse head and shoulder patterns. And then next we went on to look at the Fibonacci two retracement. Two we looked at for the golden zone, how it is always good to buy when we get a candle closure above the 0.50% Fibonacci extension points, and then where you place your stop loss, which is below the 0.618 region, according to your risk appetite. You use the risk management calculator to then know the number of lot size you are going to use for each trade you are taking in the forex market. So that is very much it for this video. I hope I've made so much impact on you, and I believe this video will help you in so many ways. I have a lot coming actually. I have a lot still yet to come, just rushing to make this video. So some of you will have something to to hold on to for this December period to prepare you for the coming year of trading, because next year is really going to be a very good year. I have the feeling that next year is really going to be a very good and profitable year for most of us. I also have plans for next year. I have much plans for next year for all of us. But I just want you guys to understand that yes, everything I post on my YouTube channel is for free, and you can always send me a message on Telegram from my channel. Send me a message on Telegram if you want to learn more. If you want a one-on-one mentorship, free mentorship. If you have a one-on-one call you want to make, or ask me probably some questions about trading, I'm always available for you, not sliding you. I am always available to answer your questions. So that is very much it for this. Remain blessed, stay blessed, and study, learn. So happy Christmas and happy New Year in advance. I wish you all the best. Keep on reading, keep on learning, and keep on doing what you have to do to stay informed in the market. Peace.